In the corporate form of organization, owners or shareholders are separated from operations or management of the company. This setup creates an agency problem, in that the management, which is the agent, may not act in the best interest of the shareholders or the principals. Managers may be tempted to engage in self-serving activities, such as shirking, taking too little or too much risk, or consuming excessive perks. Effective corporate governance involves developing an appropriate legal structure and establishing appropriate incentives or forms of compensation and monitoring devices to prevent this inappropriate activity. Shareholders are a major stakeholder of the corporation, but there are several others, including employees, customers, suppliers, government regulators, and society. The legal structure of the corporations covers the following. Articles of Incorporation. Corporations are almost universally incorporated under the laws and regulations of one of the states. A corporation is formed with the filing of Articles of Incorporation with the Secretary of State, who issues a Certificate of Incorporation. The Articles of Incorporation include the following. The Articles of Incorporation include the following. 1. Proposed name of the corporation and initial address. 2. Purpose of the corporation. 3. The powers of the corporation. 4. The name of the registered agent of the corporation. 5. Name and address of each incorporators. And 6. Number of authorized shares of stock and types of stock. The Articles of Incorporation may be subsequently amended by approval of shareholders, often a majority vote but sometimes two-thirds vote required. Shareholders dissenting from the amendments may assert their right to sell their shares to the corporation for fair value before the vote. The bylaws of the corporation set forth how the directors and/or officers are elected or selected, how meetings are conducted, the types and duties of officers and the required meetings. In addition, the bylaws should prescribe the process for bylaw amendment. For good governance, all officers and directors should be provided with a copy of the corporation's bylaws. Shareholders. Common shareholders provide the basic capital of the corporation and elect the board of directors. Annual meetings of shareholders are required as set forth in the bylaws. Certain matters require vote of the shareholders, such as amendment of the Articles of Incorporation, and fundamental changes affecting the corporation such as mergers and liquidations. Sarbanes-Oxley Act, which will be discussed later, also prescribes certain matters that must be voted on by shareholders. The common shareholders are the last to receive their capital in the event of liquidation of the corporation. Other rights of the common shareholders include 1. Right to receive dividends if declared by the board of directors. 2. Right to subscribe to stock issues so that their ownership is not diluted as set forth in the Articles of Incorporation, also known as preemptive right. 3. Right to inspect books and records in good faith and for a proper purpose. And 4. Right to sue on behalf of the corporation if officers and directors, for reasons such as director violation of fiduciary duty, illegal declaration of dividends, or fraud by an officer referred to as a derivative suit. Shareholders have no right to manage the corporation, unless they are also officers or directors. Preferred shareholders generally have no voting rights, but they have preference as to dividends and receipt of capital upon liquidation of the company. In many cases, common shareholders have cumulative voting rights in the election of directors, allowing them to cast one vote for each director of the corporation, for each share of stock they own. This allows minority shareholders to have an opportunity to elect directors by voting all their votes for one or two directors. Boards of Directors. The Board of Directors is charged with running the corporation on behalf of the shareholders and other stakeholders. It is responsible for providing strategic direction and guidance about the establishment of the key business objectives of the corporation. Examples of duties of the board include: 1. Determining the mission of the corporation. 2. Selection and removal of the chief executive officer. 3. Amending the bylaws unless this is a responsibility of the shareholders. 4. Determining management compensation. 5. Decisions regarding declaration and payment of dividends. 6. Decisions regarding major acquisitions and capital structure. 7. Advising management. 8. Providing governance oversight, with the assistance of internal and external auditors. 9. Ensuring accurate financial reporting by the corporation. And 10. Risk management. Directors are elected by the common shareholders and have no individual power to bind the corporation. The power resides in the board collectively. A majority vote of directors present is needed for most business decisions, providing a quorum is present. Actions may be taken with no meeting if allowed by the corporation's articles of incorporation or bylaws. However, there must be unanimous written consent by board members for action to be taken without a meeting. Directors must exercise ordinary care and due diligence in performing their duties, and act in a manner that they believe is in the best interest of the corporation. In addition, they must disclose any conflicts of interest. The business judgment rule is a case law-derived concept that provides that a corporate director may not be held liable for errors in judgment, provided the director acted with good faith, loyalty, and due care. Directors, however, may be held personally liable for approving and paying dividends that are illegal. Directors are also responsible for their own torts or wrongful acts even if they are acting on behalf of the corporation. The director's duty of loyalty means that they must put the interest of the corporation before their personal interest. Assume a director is approached with a business opportunity that would be of interest to and benefit the corporation. However, the director is also interested in the opportunity. The director must first offer the opportunity to the corporation before pursuing it on his or her own behalf. Officers. Officers operate the company based on the authority delegated to them by the board of directors. An officer of the corporation is an agent that can bind the corporation within the scope of his or her authority. A corporation is not bound by acts of an officer acting beyond the scope of his or her authority. The officers of the corporation are responsible for the fair presentation of the corporation's financial reports, including the financial statements. Sarbanes-Oxley Act requires the Chief Financial Officer and Chief Executive Officer to certify to financial statements. Officers have a fiduciary duty to the corporation and are liable for their own torts. Finally, the Sarbanes-Oxley Act generally prohibits personal loans to officers or directors of a public company. Various types of compensation are used to attempt to align management behavior with the objectives of the shareholders. A key objective in setting executive compensation is to align management's decisions and actions with the long-term interests of shareholders. For example, long-term stock price, If managers are given too much fixed compensation, they may become too complacent and not take appropriate risks to increase share price. If managers are given too much incentive compensation based on operating profit or short-term stock price, they have incentives to manage profit or take excessive risks to maximize their compensation. Common types of management compensation are described below. Base salary and bonuses. Using this system, managers are compensated based on performance, which is typically measured by accounting profit. Compensation systems based on accounting measures of profit are problematic, because accounting profit can be manipulated or managed. For example, the timing of research and development and maintenance expenditures may be altered to manage profit and maximize bonuses. Managers may put too much focus on short-term profits instead of focusing on maximizing the long-term wealth of shareholders. Stock options. The use of stock options as a form of compensation provides managers with an incentive to manage the corporation to increase the stock price, which is consistent with the goal of shareholders. A disadvantage of stock options is that managers may have an incentive to increase the stock price in the short term, at the expense of long-term stock value, even by manipulating accounting income to increase stock price. In addition, stock options may encourage management to take on risks that are in excess of shareholders' risk appetite. Finally, if the stock price falls substantially, the stock options may be so underwater that they no longer provide an incentive to management. Stock grants. It involves issuing shares of stock as part of management's compensation. Two common types of stock grants are: 1. Restricted stock. The issuance of stock that cannot be sold by the manager for a specific period of time, usually 10 years. This form of compensation is effective because it encourages managers to undertake operations that increase the long-term value of the corporation's stock price. And 2. Performance shares. This is the issuance of stock to management if certain levels of performance are met. If the price of the corporation's stock increases, the value of the manager's compensation also increases. Executive perquisites or perks. Management also may get various perquisites such as retirement benefits, use of corporate assets, golden parachutes, and corporate loans. The best forms of executive compensation. It is generally believed that the best compensation systems include a combination of fixed compensation and incentive compensation that is related to long-term stock price. Bonuses are effective if they are based on a composite of performance measures, in addition to net profit, such as the amount of research and development expenditures, the corporation's market share, the number of new products developed, and the percentage of stock held by institutional investors, who tend to hold the stock for the long term. Such performance systems are often referred to as a balanced scorecard. Monitoring devices. Various devices exist in the United States to monitor management behavior. Some of the devices are internal. For example, the board of directors and internal auditors, while others are external. For example, external auditors, analysts, credit agencies, attorneys, the SEC, and the IRS. Board oversight. To be effective at providing governance oversight, board members must be competent, and a majority of the board members should be independent. Independence means the board member is not part of management of the corporation, and does not receive significant benefit from the corporation, other than compensation as a board member. Directors also must be adequately trained and be provided with complete and accurate information to carry out the board's functions. Officers, employees, or major stockholders, who are on the board of directors, are referred to as inside directors. The Wall Street Reform and Consumer Protection, or the Dodd-Frank Act of 2010, requires public corporations to disclose why or why not the chairman of the board is also the chief executive officer. Boards of directors should have a set of governance guidelines that are reviewed and revised annually. These guidelines will set forth the board organization, which will include its various committees and subcommittees. Committees that are particularly important to effective corporate governance include: the Nominating or Corporate Governance Committee oversees board organization including committee assignments, determines director qualifications and training, develops corporate governance principles, and oversees CEO succession. The Audit Committee plays a critical role in corporate governance. The Sarbanes-Oxley Act defines the Audit Committee as a committee established by and amongst the board of directors of an issuer, for the purpose of overseeing the accounting and financial reporting processes of the issuer, and audits of the financial statements of the issuer. A major responsibility of the Audit Committee is the appointment, compensation, and oversight of the corporation's external auditor, including the resolution of any disagreements between management and the external auditor. An independent audit committee is mandated by the Sarbanes-Oxley Act, regulations of the New York Stock Exchange, and NASDAQ. Other important characteristics of an audit committee includes the following. The Sarbanes-Oxley Act provides that at least one member should be a financial expert. The names of the financial experts must be disclosed. If the firm does not have a financial expert, it must provide an explanation. A financial expert is one that possesses all of the following attributes. 1. An understanding of generally accepted accounting principles and financial statements. 2. Experience in preparing, auditing, analyzing, or evaluating financial statements of the breadth and complexity expected to be encountered with the company. 3. An understanding of internal controls and procedures for financial reporting. And 4. An understanding of audit committee functions. These attributes may be acquired through 1. Education and experience as a principal financial officer, controller, public accountant, or equivalent. 2. Experience supervising an individual in one of the positions mentioned. 3. Experience overseeing or assessing the performance of companies or public accountants with respect to preparing, auditing, or evaluating financial statements. Or 4. Other relevant experience. The Audit Committee should appoint corporations' external auditor, determine their compensation, and oversee their work. External auditors must report directly to the Audit Committee. Internal auditors should have direct access to the Audit Committee. The Audit Committee should establish procedures for the receipt and treatment of complaints regarding accounting or auditing matters, including submission of concerns by employees or whistleblowers. The Dodd-Frank Act provides for civil actions by whistleblowers who are retaliated against by the company. Section 302 of the Sarbanes-Oxley Act requires certification that the CEO and CFO have reviewed the quarterly and annual financial reports filed with the SEC. and they believe that they are fairly stated and contain no material misstatements. They are also responsible for establishing and maintaining internal controls that are designed to assure that relevant information is made known to them. And lastly, they have evaluated internal controls and believe that controls are effective as indicated in management's report on internal control. They must also certify that they have reported to the auditors and the audit committee all significant deficiencies in internal control, and are not aware of any post-evaluation changes that could significantly affect controls. The Compensation Committee reviews and approves CEO compensation based on meeting performance goals. The Compensation Committee also makes recommendations to the board with respect to incentive and equity-based compensation plans. They also attempt to align incentives with shareholder objectives and risk appetite. The Dodd-Frank Act established a requirement that all members of the Compensation Committee of public companies must be independent. In addition, shareholders must be allowed a non-binding vote on executive compensation at least every 3 years, and a vote at least every 6 years as to whether the vote on compensation should be held more often. Finally, the Act also requires a non-binding vote by shareholders on golden parachutes to be provided to executives as a result of major transactions. Among other items, the New York Stock Exchange and NASDAQ require listed corporations to 1. Have a majority of independent directors on their boards. 2. Identify certain relationships that automatically preclude a board member from being independent. 3. Have non-management directors meet at regularly scheduled executive sessions. 4. Adopt a comprehensive code of conduct applicable to all directors, officers, and employees, and disclose any waivers of the code for directors or executive officers. The code should be distributed to employees, officers and directors, and reinforced in training sessions. The code should be periodically acknowledged by all employees. 5. Have an independent audit committee. In addition, nominating or corporate governance and compensation decisions must be made by independent committees, or a majority of independent directors under NASDAQ. And 6. Make determination of independence of members and provide information to investors about the determination. Specific New York Stock Exchange and NASDAQ rules that make a director not independent include the following. A director is not independent if he or she has been an employee of the corporation or an affiliate in the last 5 years, or 3 years under NASDAQ rules. A director is not independent if a family member has been an officer of the corporation or affiliate in the last 5 years, or 3 years under NASDAQ rules. A director is not independent if he or she was a former partner or employee of the corporation's external auditor in the last 5 years, or 3 years under NASDAQ rules. A director is not independent if he or she or a family member in the last 3 years received more than $120,000 for a 12-month period payments from the corporation, other than for director compensation. And finally, a director is not independent if he or she is an executive of another entity that receives significant amounts of revenue from the corporation. It is important to remember that judgment must be used to determine whether a director is independent. For example, based on the facts and circumstances, it may be concluded that a director is not independent even though he or she receives less than $120,000 in just payments other than director compensation. Internal auditors. Internal auditors perform audits of the risk management activities, internal control, and other governance processes for the corporation. Such audits are often referred to as assurance services. The results of these audits should be communicated directly to the Audit Committee of the Board of Directors. The New York Stock Exchange requires its listed companies to maintain an internal audit function to provide management and the Audit Committee with ongoing assessments of the company's risk management processes and system of internal control. The Institute of Internal Auditors is a professional organization of internal auditors. Among other activities, the Institute of Internal Auditors has issued international standards for the professional practice of internal auditing and a code of ethics for internal auditors. This organization also administers the Certified Internal Auditor or CIA program. To become a CIA, an individual must pass a multi-part exam and have a minimum of 2 years of internal audit experience or its equivalent. The CIA designation helps to demonstrate that the individual is competent to perform internal audits. The international standards for the professional practice of internal auditing, much like generally accepted auditing standards, include rules and interpretations. They cover the 2 types of services that internal auditors perform. 1. Assurance services. It involves providing an independent assessment of governance, risk management, or control processes of an organization. Examples include assurance about financial presentation, compliance, performance, and system security. And 2. Consulting services. It involves advisory-related services to improve an organization's governance, risk management, or control processes. Examples of consulting services include training, advising, and facilitating. The internal auditing standards are broken down into 1. Attribute standards related to the characteristics of the internal audit activity, and 2. Performance standards related to the quality of internal audit activities. The international standards also include implementation standards that expand upon the attribute and performance standards. Aspects of the international standards for the professional practice of internal auditing that relate particularly to corporate governance include 1. The purpose, authority, and responsibility of the internal audit activity should be formally defined in the Internal Audit Charter. The Internal Audit Charter should recognize the need to adhere to the Code of Ethics and international standards for the professional practice of internal auditing. The standards apply to individual internal auditors and internal audit activities. 2. The internal audit activity must be independent, and internal auditors must be objective in performing their work. Independence for the internal auditor activity is achieved by organizational independence, which means auditors cannot be influenced by the management of the functional areas that they audit. Accordingly, the Chief Audit Executive should report to a level within the organization that allows the internal audit activity to fulfill its responsibilities. For effective organizational independence, the Chief Audit Executive ideally should report functionally to the Audit Committee and administratively to the Chief Executive Officer of the corporation. Examples of functional reporting to the board include board approvals of the Internal Audit Charter, budget and resource plan, risk-based audit plan, remuneration of the Chief Audit Executive, and decisions regarding appointment and discharge of the Chief Audit Executive. This helps to prevent the auditor's work from being influenced by management of the corporation. In addition, individual internal auditors must have an impartial, unbiased attitude, and avoid conflicts of interest. If independence is impaired, the details of the impairment should be disclosed to appropriate parties. 3. Internal audit engagements must be performed with proficiency and due professional care. Proficiency means that the internal auditors must possess the knowledge, skills, and competencies needed to perform their individual responsibilities. This includes a sufficient knowledge of key information technology risks and controls, and information technology audit techniques, and a sufficient knowledge to evaluate fraud risk. 4. Internal auditors must enhance their knowledge and skills with continuing professional development, and the Chief Audit Executive must develop and maintain a quality assurance and improvement program. Quality assurance and improvement programs should include internal and external assessments. Internal assessments that include ongoing monitoring of performance and periodic reviews through self-assessment or review by other qualified individuals within the organization, while external assessments at least once every 5 years by qualified independent assessors. The Chief Audit Executive should communicate the results of the quality assurance and improvement program to senior management and the board. 5. The internal audit activity must evaluate the effectiveness and contribute to the improvement of the corporation's risk management processes, and assist the management in maintaining effective controls by evaluating their effectiveness and efficiency and promoting continuous improvement. 6. The Chief Audit Executive must establish risk-based plans to determine audit priorities. Must also effectively deploy internal audit resources to achieve the plan, and establish effective policies and procedures to guide audit activities. 7. The Chief Audit Executive should share information and coordinate work with other internal auditors and external auditors. 8. The Chief Audit Executive should periodically report to senior executives and the board on the internal audit activity's purpose, authority, responsibility, and performance relative to its plan. Reporting must also include significant risk exposures and control issues, including fraud risks and governance issues. 9. The internal audit activity must assess and make appropriate recommendations for improving the governance process in its accomplishment of objectives in the following areas. 1. Promoting appropriate ethics and values within the organization. 2. Ensuring effective organizational performance management and accountability. 3. Communicating risk and control information to appropriate areas of the organization. And 4. Coordinating the activities of and communicating information among the board, external and internal auditors, and management. 10. The internal audit activity must evaluate the effectiveness and contribute to the improvement of risk management processes. 11. The internal audit activity must assist the organization in maintaining effective controls by evaluating their effectiveness and efficiency and by promoting continuous improvement. 12. Audit engagements should be adequately planned, including appropriate identification of objectives and scope. Audit work programs should be developed, and audit work should be adequately supervised. Engagements should be assigned adequate resources, and sufficient information should be collected and analyzed to achieve the audit objectives. Finally, results should be effectively communicated. And 13. The Chief Audit Executive must establish and maintain a system to monitor the disposition of audit results communicated to management. External auditors. The external auditor is responsible for performing an audit of the corporation's financial statements and internal control, in accordance with standards of the Public Company Accounting Oversight Board. The external auditor is a major external corporate governance monitoring device for a corporation. The external audit helps assure that corporation financial reports are accurate, and management is not engaging in fraudulent financial reporting. Section 404 of the Sarbanes-Oxley Act requires that management acknowledge its responsibility for establishing adequate internal control over financial reporting, and provide an assessment in the annual report on the effectiveness of internal control. For large public corporations, it also requires that external auditors attest to management's report on internal control as part of the audit of the financial statements. External auditors are required to communicate to the audit committee those information that will help the committee perform its oversight function, including the following matters. 1. Auditor responsibility to form and express an opinion. 2. An audit does not relieve management or the audit committee with their responsibilities for governance. 3. Planned scope and timing of the audit. 4. Significant audit findings includes auditor views of qualitative aspects of significant accounting practices, significant difficulties encountered during the audit, disagreements with management, other findings or issues which the auditor believes are significant and relevant, and uncorrected misstatements other than those that are trivial. 5. Material corrected misstatements. 6. Significant issues discussed with management. 7. Auditor's views about significant matters on which management consulted with other accountants. 8. Written representations the auditor is requesting. 9. Significant deficiencies and material weaknesses in internal control. Section 802 prohibits a person from knowingly destroying, mutilating, or concealing records or documents to impede or influence the investigation of any department or agency of the United States. The penalty is a fine or imprisonment for not more than 20 years, or both. Investment banks and securities analysts. Investment bankers help corporations issue equity and debt offerings. Therefore, they represent an external monitoring device because they must evaluate the company prior to becoming involved in selling the securities. Securities analysts analyze companies to attempt to develop recommendations to buy, hold, or sell a particular corporation's stock. Therefore, securities analysts act as an external monitoring device because they use financial and non-financial information, including information about corporate management, to make their recommendations. An issue with considering the recommendations of analysts is potential conflicts of interest. For example, analysts may be employed by firms that also perform investment banking activities, and the analyst's recommendations may be influenced by the fees received from the corporation for investment banking services. Regulations adopted by the SEC attempt to control these conflicts of interest by, among other requirements, requiring analysts to certify that their compensation will not be impacted by their recommendations. Creditors. Creditors also act as an external monitoring device. Debt agreements contain covenants or requirements that must be complied with to prevent the creditor from taking actions such as accelerating payment terms. Creditors monitor compliance by the corporation with the covenants of these agreements. One limitation of creditors as a monitoring device is that they monitor largely based on information provided by management. However, they do often engage external auditors to perform procedures to provide assurance about the corporation's compliance with certain covenants of the loan agreements. Credit rating agencies. Credit rating agencies rate the creditworthiness of corporate bonds. Credit rating agencies are an external corporate monitoring device, much like securities analysts. The biggest criticism of credit rating agencies is that they may improperly set the initial rating and are slow to downgrade the rating once the corporation gets in financial difficulty. Note that the Dodd-Frank Act has provisions that help prevent conflicts of interests and increase transparency by credit rating agencies. Attorneys. Corporate legal counsel provide another external monitoring device in that they review securities filings and provide management advice on legal matters. The Securities and Exchange Commission The SEC is responsible for protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. In achieving these responsibilities, the SEC enforces the U.S. securities laws. The SEC consists of 5 presidentially appointed commissioners. The SEC's activities act as an important external monitoring device for corporate governance. The divisions and offices of the SEC that are particularly relevant to corporate governance include 1. Division of Corporate Finance. This division reviews documents of publicly held companies that are filed with the SEC. Through the review process, the division checks to see if companies are meeting disclosure requirements and seeks to improve the quality of the disclosures by companies. 2. Division of Enforcement. This division assists the SEC in executing its law enforcement function by recommending the commencement of investigations of securities law violations, recommending which cases to take to court, and prosecuting these cases on behalf of the Commission. 3. The Office of the Chief Accountant. The Chief Accountant advises the Commission on accounting and auditing, oversees the development of accounting principles, and approves the auditing rules put forward by the Public Company Accounting Oversight Board. Several provisions of the Sarbanes-Oxley Act improve the SEC's power as an external monitoring device, including 1. Section 906 of the Sarbanes-Oxley Act requires the CEO and the CFO to certify the accuracy and truthfulness of periodic financial reports filed with the SEC. If the certification of the reports is later found to be inaccurate, the CEO and CFO can be found criminally liable and face imprisonment of 10 to 20 years. Also, civil penalties can involve fines of up to $5 million. 2. Sarbanes-Oxley requires public companies to disclose in their filings whether they have established a code of ethics for senior financial officers. 3. Under Sarbanes-Oxley, any person who knowingly perpetrates or attempts a scheme to defraud any other person by misrepresenting or making false claims in connection with the purchase or sale of securities can be fined or imprisoned for up to 25 years, or both. While securities fraud has long been an offense under the other Securities Acts, Sarbanes-Oxley made prosecution much easier. 4. The destruction, mutilation, alteration, concealment, or falsification of documentation with the intent to obstruct or influence an investigation that is ongoing or being considered, can result in fines or imprisonment of up to 20 years. 5. Sarbanes-Oxley prohibits any acts of retaliation against employees or whistleblowers who alert the government to possible violations of securities laws. The punishment for a violation of this provision can include fines or imprisonment of up to 10 years or both. The Internal Revenue Service. The IRS acts as an external governance device by requiring certain accounting information on the corporation's income tax return. The IRS also audits corporations' tax returns and enforces penalties for filing false tax returns. Corporate takeovers. Takeovers also act as a corporate governance device. If management is performing poorly, the corporation may be subject to takeover by a firm that believes it can more efficiently utilize the corporation's resources. This provides an incentive for management to operate the corporation consistent with the interests of the shareholders. Corporations sometimes engage in strategies to prevent a takeover, such as a poison pill defense. A poison pill defense triggers an option for the shareholders to purchase additional shares at a discount, if someone attempts to acquire a controlling interest in the corporation. Such defenses are controversial because they inhibit an active market for corporate control.